Let's go to the United States now, and the US Central Bank has announced a rise in interest rates of 3/4 of a percentage point, the largest since 1994. The Federal Reserve is trying to curb inflation, which reached an annual rate of more than 8.5% last month. Well, Nina Trentman is Bureau Chief at the Wall Street Journal. She joins us now from New York. Nina, good to see you. It's the biggest interest rate rise in nearly 30 years. Why now?
Well, you just mentioned it basically because of recent inflation figures that came out on Friday at 8.6 for May, which is an increase from 8.3 in April and similar rate to what we saw in March. I think we just saw in recent days that there was this momentum building up in the markets and among market participants, and also then Federal Reserve officials of saying, well, okay, maybe we shouldn't wait until July to increase rates by that much, but we should do it now, given that the Fed also faces criticism of having waited too long before it started raising rates and wound down its quantitative easing programs that were launched in the pandemic to help the economy. And now, of course, we're seeing inflation being persistently high, influenced by various factors, and the Fed just trying to take action and trying to tamp down inflation.
Practically, what does this interest rate rise mean for day-to-day living for most people?
I think one thing to watch will certainly be mortgage rates. Mortgage rates have gone up quite significantly in recent months. And so the expectation is that that's going to continue with rates increasing. We will also see increases in financing costs for companies, as well as increases in sort of interest charge for consumer loans as banks start to pass on these higher interest rates to their customers, which includes consumers, corporate clients. So this is going to be, of course, gradual because rates are still comparatively low after a very long time when they were near zero. So it's going to take time until they're at a level where one would say, okay, this is now a significantly higher rate. Like, still remember, like, we're going to be at 1.5 to 1.75 for the federal funds rate, which is still, historically speaking, relatively low, but still it will show, and consumers as well as businesses will see it.
Well, on that business front, it's often smaller businesses. They don't have the cushioning that larger businesses have. They tend to be affected by these things more quickly. What will happen to businesses? What will they have to do to mitigate against this?
I think, as you pointed out quite rightly, I think it depends very much on who we mean by business, because the large US corporates in the S&P 500 and the Fortune 500, they've seen this coming. And of course, they've, since the summer of last year, basically started refinancing existing maturities and basically have pushed out any upcoming debt maturities sort of to 2024, 25. So there's not necessarily that many companies in the investment grade space that will be impacted by this or largely impacted by this. But that's, of course, different if we're talking about smaller businesses, and also if we're talking about companies that don't have very strong credit ratings, that are sort of in this below investment grade space. The expectation is that pressures will rise for those companies, and that there's going to be an increase in defaults and in financial stresses. Of course, coming from a low base, defaults have been pretty low in recent months, but there's going to be a change for those businesses. And what we're seeing is that companies across the board are, of course, reviewing their financial statements, and they're looking at their exposure and, of course, trying to take mitigating actions, including seeking additional funding if needed, as well as I pointed out earlier, sort of pushing out maturities and trying to prepare for more interest rates to come, because the Fed was also pretty clear today that today's rate hike was just one of several more to come. So the expectation from a corporate perspective is that from now on and even before was that just financing costs will keep going up. The expectation is for next year in 2023 to have a federal funds rate of around 3.75, which is, of course, quite an increase from previous projections from the Fed. So those 3.75% then, of course, get us to a level where also things will start getting more pricing.
Okay, we'll have to leave it there. Nina Trentman, Bureau Chief at the Wall Street Journal in New York. Thank you.